My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. My friends, I'm just trying to help you make a little money. My job is not just to entertain, but to explain and educate. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. All last week, I told you that rather than selling everything, you should just sit on your hands. Because once the pain ends, we're going to bounce right back. Sure enough, the averages were today, with the Dow gaining 484 points. S&P jumping 1.16%. NASDAQ also climbing 1.16%. Okay, I know, it's nowhere near making it back, but it shows you that selling into Friday's vortex didn't work as a tactic, did it? If you recall, last week represented a disaster for some of the most economically sensitive stocks, as well as tech. I couldn't make sense of it, because the only big thing that happened last week was the August employment report, which showed mild growth and a sizable revision down for July. To me, this was a great number if you're hoping for Fed rate cuts. We needed a Goldilocks set of figures, not too hot, not too cold, and that's exactly what we got. Wall Street disagreed vehemently, though, in my view. The market reacted as though we were headed for a recession, with people dumping the cyclicals and buying the slowdown plays, like the consumer packaged goods stocks, drug stocks, that kind of thing. The industrials and the semis were really hard hit, especially, well, I got to tell you, the industrials, mind-numbing. And I'll tell you why. We had Caterpillar's Jim Umpleby, the CEO, on Thursday night. Geez, I thought he told a terrific story, and yet the stock just got obliterated the next day. I felt like I completely missed something. You buy Caterpillar if you think the Fed can reignite the economy by cutting rates. It should have been a winner Friday. Of course, we come back from the weekend, and it turns out that I wasn't wrong at all. Friday was wrong. CAT jumped $4.68 today, making a fool of those who dumped it on Friday. Today, it looked like the buyers had realized that the Fed's rate cuts are going to work. Now, that's a reasonable explanation, but I think there's a better one. Nothing mattered, because nothing really happened at all, except for stocks going zigging and zagging. CAT's not alone. On Friday, many were buzzing about the relentless decline in the semiconductor ace ARM Holdings. The stock fell from 123 down to 117, and this was after already coming down from 132 at the end of the previous week. ARM seemed spent. It seemed done. Then today, it shoots back up to 125. It's up 7%. Supposedly because the new iPhone is using their latest design for custom processors. Something that should have been obvious to everyone for months. Was Friday's sell-off based on pure emotion and today's rally based on motion right back? Or did nothing truly happen at all to ARM on Friday or Monday? How about this absurdity? Supermicro, a partner of NVIDIA, fell from 414 to 386 on Friday, still hobbled by a report from short seller Hindenburg about the company's aggressive accounting. But then today, Supermicro were back to almost 410. Again, either the decline was meaningless or the rebound was meaningless, or they're both meaningless. We don't know. Meanwhile, today was still one more day where the recession-proof stocks rallied again. Think the pharmaceuticals, drug wholesalers, they were really strong. Medical device stocks, along with the food and beverages. Feels like these stocks have now made parabolic moves. They're not growth stocks, for heaven's sake. Straight up. That's definitely dangerous with a limited shelf life. Which brings me to the sobering fact about this tape. We have more noise here than any other time I can recall. Noise so loud that people keep making the wrong moves. What should be happening? Look, we know how the market behaves historically when the Fed's about to start cutting interest rates. We've seen it over and over and over again. I built a whole playbook around it at my old hedge fund. Right now, the Fed just switched to favoring easing over the status quo. We got a reaffirmation of that with Friday's employment numbers. We're almost certain to get a rate cut at next week's Fed meeting. So what happened on Friday? I'll tell you what happened. The market made a mistake. At this point in the business cycle, with the rate cuts tantalizingly close, you're supposed to start selling the recession-proof stocks, the food stocks, the drug stocks. The big gains in Coca-Cola and Colgate should be over. It's why we trimmed some Procter & Gamble for the charitable trust. Hey, by the way, that's something we're going to talk about at Thursday's CNBC Investing Club meeting at noon. I wish you'd sign up so you can hear it. Procter's the wrong stock when we're going into a rate cut cycle, and we own Procter. At the same time, you need to keep the industrials that are more secular these days than cyclical, like Caterpillar, or Eaton, the latter, which announced a home electric charging deal with Tesla. Like Cat, Eaton was up huge. More important, when the Fed starts cutting rate, you're supposed to buy the most cyclical companies hand over fist, the ones that are totally hostage to the underlying economy. Companies like Nucor, the largest steelmaker in America. Nucor's done a great job of cutting costs, so if the Fed can stop the decline in steel prices, by just having it so that there's more economic activity, maybe send them back up. This stock's going to be a huge winner. Oh, I know it's hard to buy smokestack stocks in a slowdown. But once the Fed starts cutting, the economy should turn around. You got to anticipate that. That's the playbook. The only real question, do you sell the consumer packaged goods play so you can take that money and swap into cyclicals? And should you go for the deepest cyclicals, the ones that will soar if the economy improves rapidly? Cyclicals like Cleveland-Cliffs, a less efficient steel maker than Nucor. Historically, the defensive stocks get less and less attractive as the Fed cuts rates because their earnings stay consistent while the cyclicals start putting up tremendous growth. Buy! Of course, it's very early to make any of these kinds of judgments. People want to make it. They want to do it. You can't. You'd be anticipating the actions of too many market players. I'm not willing to endorse dumping all your defensives and keep on. I don't want you to go all in on the deep cyclicals. We believe in diversification on the show. But, man, rate cuts are coming. So everything else is just noise, including what happened Friday and yesterday. Apple introduced a new phone, and nobody seemed to care. I think this is one of those product launches that's lost on Wall Street, but eventually loved on Main Street. Wall Street doesn't care about better battery life or draft spell checks or being able to take a picture of a restaurant, immediately seeing the reviews. It doesn't care about AI functionality. The Street just wants to know the rollout schedule so they can make their earnings models. But Main Street wants everything Apple's offering. And you know the wireless carriers will push the new iPhone 16 like they do with every iPhone iteration. Which brings me back to sitting on your hands. Most of the big moves are a product of algorithms, which spit out strategies that worked before. They can create a ton of volatility. Rather than trying to figure out what's driving these irrational moves, you should focus on buying dips in high-quality stocks when there's no data, like Apple, which I would have told you, own, don't trade. At the same time, I'd use the strength to sell some of the defensives that have gone parabolic. They seem risky to me. And, of course, you need to judge whether to buy Apple stock tomorrow morning, right? When the negative Wall Street analysts clash with the rabid desire of Apple users to buy the new iteration. That's substantive. I'm hoping for you that Apple opens down. The bottom line, Apple's anemic 9-cent rally was the only true move in a session dictated by larger macro forces that are most likely wrong by themselves, but possibly right when taken together with recent action. So rather than freaking out during Friday's sell-off, or just celebrating today, you could have just sat on your hands and spared yourself the angst and friction that comes with endless buying and selling. How about we go to Kyle, New Jersey? Kyle.
My best friend, Jim Cramer. How you doing, buddy?
I didn't even know we were that close, but you know what? I'll take it. What's happening?
We're very close, man. Listen, I'm just a handyman, and you're like the smartest guy that I know. You're a Harvard grad, and David Tepper's a really smart dude, too.
Tepper?
They just became profitable.
Yeah, I saw that. They didn't have that good a game yesterday, but that's not his fault because he's not suiting up. He should not be blamed.
He should have bought somebody else instead of the Panthers, I think. But they have a $4.5 billion market cap. They just became profitable. What am I missing in Lyft here?
Okay, so it got overheated. I think Pebble felt that it was like, it's a real true duopoly, that nothing can go wrong. But I'm with you. I think Lyft should be bought here because it is now inexpensive, believe it or not, on the numbers. And you know what? You are my best friend. And I totally forgot my best man, Michael Haley. He's out. He can go to Vegas for all I care. Let's go to Tony in Florida. Tony.
Hey, Jim, I just wanted to know I'm a member of your club since day one, and I really enjoy you and Jeff. But I got to give a big booyah, to your staff. They're so friendly, and they make you feel at home when you call in.
They are absolutely great. And I've got to tell you, thank you for saying that because I don't credit them enough. Our viewers know who to credit. Thank you very much. And just don't forget our noon meeting Thursday with Jeff talking about our new initiation. How can I help you?
Well, I do have some cash on the side for that because that I always listen to. But this stock last week went down with the market, but it went up a lot. I don't have any cyber, and it's a 2. Should I buy just a small of it and then hold it power out, though?
If it weren't up 8 today, I would say yes. I don't want you to come in on possible quicksand, as people may say, you know what? That move yesterday wasn't for real because people are doubting every single move. You wait. That's what you do. You wait. And thank you for the kind comments. On days like we had today, you want to avoid selling what you shouldn't and, well, don't buy what you shouldn't either. How about this? Sit on your hands. On Mad Money tonight. Are some chip companies actually a bargain at these levels? I'm taking a close look at what's behind the semi sell-off and then give you my take. Then I'm going off the charts to get a read on where the deflation trade is heading. And later, I'm checking in with the CEO of Medtronic as he breaks down how AI is shaping the future of healthcare, and it's making the money. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
All right, I got something to say about this mini semiconductor bear market. For the last couple months, Wall Street learned to love to hate the chip stocks. The whole group's down almost 22% from its highs on July 11th, as represented by the SMH. That's a key semiconductor ETF. Many individual names have come down even harder from their highs. Intel is off a staggering 63%. Micron down 45%. AMD's lost almost 40%, just to name the most egregious examples. Now, some of that's simply because the chip stocks got overheated. While the SMH may be down 22% from its highs, it's still up over 25% year to date, comfortably outperforming the S&P 500. They rallied too far, too fast, and need to come in. On top of that, you've got these pervasive worries about AI spend. For the past few months, we've been hearing that the companies spending fortunes on AI infrastructure simply aren't seeing enough of a return yet, and they might start dialing back their investment at some point. Now, I don't see much evidence of this, though. The bears will point to NVIDIA's failure to report a spectacular revenue beat, but that only happened because their new AI chip Blackwell got delayed. They are having trouble producing it at scale. That's totally reasonable. But they've basically solved the problem now. Supply problem, not a demand problem. Demand is off the charts. Finally, you've got people worrying that we're headed into a recession, which could hit all kinds of tech hardware and trickle down to the semis. But the Fed's about to cut interest rates next week. And an easing cycle will bolster the economy. Buy. Plus, this very evening, we got a startlingly a good report from Oracle. And a lot of the good news came in concert with data centers for AI. Hey, not bad. In the end, I think the chip stocks have sold off way too hard. Every reason we had to like this group earlier this year remains intact. The AI spending boom is very real. There's a ton of money being spent to build out the infrastructure, as we heard from Oracle this evening. More important, there's more to chips than AI. For the past couple of quarters, we've been exiting a period of oversupply in the semiconductor market, and we're now finally seeing some excellent sales growth. Yes, we're past the point of equilibrium. We're going up. The semis just had their 4 straight months of sequential sales growth in July. Do you really want to abandon this group just as we're coming out of a supply glut? You should do it when you're going into one. I don't want to go away from this group, which is why I want to give you a shopping list tonight of semiconductor stocks that have been put on sale that I really like. I love to pound the table on NVIDIA, but I still think we need to wait for the hot money to come out of that one. Too many summer soldiers and sunshine patriots, thank you, Thomas Paine, who need to wave the white flag before the stock can really bottom. I heard it today called no man's land. I like that. Besides, you can find bigger discounts than NVIDIA among the other chip makers. First, there's AMD, an on again, off again charitable trust holding. By the way, we'll be talking about it on Thursday at our monthly meeting. And it's now on because we started buying some of it when it sold off in July. AMD actually began its slide in March and is now down close to 40% from its highs. It's the third worst pullback of any chip maker in the S&P 500. Stock's down 26% just from its from the lower high on July 10th, and even after rebounding a few bucks today. Do you know that AMD is down? Do you know that it's red for the year? Down for the year. Maybe we came in a little too early for the Charitable Trust, but we've added the position on the way down because it's not like the fundamental story has changed, and that's what we do. While NVIDIA is currently unrivaled in the red-hot AI infrastructure space, AMD's in second place. It's not a close second, but there's nobody in third. And they're the only company on earth that stands a chance of catching up to the not-too-distant future, although everyone's pretty understanding the lead that NVIDIA has. Now, AMD's been rolling out their own high-end chips for AI. Demand's terrific. When AMD unveiled the MI300 last December, it projected $2 billion in sales for 2024. In late January, they raised the product sales to $3.5 billion. In late April, they boosted it to $4 billion. Most recently, in July, they took it at $4.5 billion. What does the market want, for heaven's sake? Really, AMD's latest quarter was pretty good across the board. Modest sales and earnings beat with better than expected guidance for the current quarter. Stock initially jumped 4% on the news. I thought that was right, but that was right before the yen carry trade imploded and the whole market got obliterated. It's like people just forgot that great quarter ever happened. AMD also gets no respect whatsoever for a couple of smart deals they announced over the summer, picking up ZT Systems and Silo AI, bolstering their cloud and AI software exposure, giving them a large number of engineers. Keep in mind, AMD's number 2 in AI because NVIDIA's a well-developed software ecosystem. But these deals will help them close the gap. That's what they need to do. Finally, you'll hear a lot about how Intel's core business is falling apart. But you almost never hear anyone pointing out that this is fantastic for AMD, their closest competitor in the CPU business. They're taking tons of market share in desktops and servers. Now, AMD is expected to earn $5.45 per share next year, with that number growing to $7.24 per share in 2026. But in a few months, 2026 will be next year, at which point the stock will be selling for less than 20 times next year's earnings. I believe in CEO Lisa Su, and I think AMD is a great buy into weakness, and I've got to tell you, that puts it below a market multiple. That's wrong to me. What else? I'll give you a couple more quick ones, starting with Micron, the market leader in memory chips, with a stock down nearly 50% from its mid-June highs. I'm sorry, I'm pressing the bull button for that one. The core thesis here, the hyperscalers are building all these data centers to power artificial intelligence, and these data centers, well, they need tons of memory, and that's true. Micron's bread and butter. Frankly, this harsh sell-off seems insane to me, given that Micron's business has been accelerating hard over the past 2 quarters, and not just in AI. They delivered a monster sales and earnings beat when they reported in June, while issuing much better than expected guidance for the current quarter. Now, we're going to get these results later this month, but I haven't seen anything that makes me believe that they'll be any worse than the numbers we got in June. That would be unlikely. Micron's now in its 2025 fiscal year, where it's expected to earn $9.59. With the number growing to nearly $13 in the following year. In other words, Micron's trading at less than 7 times next year's fiscal year's earnings estimates. Insanely cheap, but remember, what that often means is people don't believe in the estimates. That's how it gets to 7. I understand that. I think the estimates are okay. Finally, do not forget about ARM Holdings, ARM, the semiconductor design kingpin. That stock has more than doubled since it came public again, roughly a year ago. That's despite pulling back from 188 in early July to 125 today. ARM got a nice boost today on now confirmed reports that its chip designs are being used in the just-launched iPhone 16. That's the processors built on their architecture. That is not a shocker, but some people don't understand that. ARM's unique in that it designs semiconductor architecture, then licenses it out to chip makers and collects royalties on their sales. This gives them a nice, predictable revenue stream. Their technology is firmly entrenched in the data center, mobile devices, even the CPU portion of NVIDIA's top AI platforms. They'll be big winners from a new smartphone upgrade cycle fueled by all this new AI functionality. There's a reason Apple went with ARM's architecture. They dominate the mobile space. Again, I'd be a buyer into the recent weakness because I think the long-term upside potential is enormous, and I don't mind that it's up that much today. It can go further. Here's the bottom line. It's time to fall back in love, people, with the semiconductors, with some of the most beaten down chip stocks, most certainly. They've been punished enough. And now you are finally getting a chance at discounts to buy AMD, Micron, and ARM Holdings. Mad Money's back after the break.
Coming up, don't be stuck with the market's mood swings. Get ahead of the pack with Off the Charts. Next.
I love days like today, but there's no denying this market has severe mood swings. Last week was terrible for no particular reason. Now today's great, even though nothing's really changed. Sometimes we get caught in this cycle where we try to find a fundamental explanation for the action. But the action's got nothing to do with the fundamentals. It's about positioning. It's about market mechanics. And that's why tonight we're going off the charts with the help of Carly Garner. Oh, she's a terrific technician who's the co-founder of DeCarly Trading, the author of Higher Probability Commodity Trading, in order to show you what's going on beneath the surface. See, occasionally trades simply get, this is a real Wall Street term, overcrowded. It could happen on the long side or the short side. Right now, Garner thinks the longs have gotten overcrowded in the S&P 500 futures, and the shorts have gotten overcrowded in the grain futures. Why does this matter? Because when a trade gets overcrowded, that's a sign that it's about to run its course, and the trend's about to change directly, at least temporarily. Remember, charting, we try to figure out what's going to happen, big moves, before they happen. Now, that's why this is a great teaching lesson. Garner believes the S&P 500 is reaching a climax of euphoria, while the grains are experiencing a cascade of negativity. Bulls have piled into the S&P futures in extreme numbers, while the short sellers have done the same in the grains. As a result, there's now a 75% negative correlation between the stock market and the price of ag futures like corn and soybeans. That's because you buy stocks if you believe the Fed has beat inflation, but you sell agricultural commodities for the same reason. Historically, this is incredibly abnormal. Last week, the grains finally found a bid as the stock market sold off. Garner believes that last week people decided to take the other side of the trade, swapping from stocks into grains. Today, both groups went higher. But if the stock market goes back into sell-off mode, easy to see happening in this horrible month of September, then Garner thinks that could trigger a short squeeze in the grain complex. Yes, she thinks of that interrelated. So I want you to take a look at the daily chart of the S&P futures in green and corn futures in yellow going back to 2022. When inflation was rampant in 2022 and early 2023, we had a huge commodities boom, okay? These charts are actually pretty amazing. This corn futures, we had a commodities boom. Because inflation means the prices are headed higher and investors wanted a piece of the action. At the same time, money flowed out of the stock market as we worried about the Fed raising interest rates to stamp out inflation, cooling the economy in the process. So you're seeing this and this, okay? That's where I'm talking about the going up and going down. But by the end of last year, the inflation trade turned into a deflation trade. People sold commodities and they bought stocks. That's been terrific for the stock market, but Garner believes that these big trades ultimately exhaust themselves and then reverse. It's what's happened to the inflation trade, and she's betting we'll see the same thing with the deflation trade. So, now let's start with the E-mini S&P 500 futures. Take a look at this weekly chart, which includes the CFTC's commitment of traders down here, commitment of traders data. This is a terrific tool, but there are different versions of it. Normally, we look at the simple legacy version of the Commitment of Traders report, breaks into investors down into small speculators, large speculators, and commercial hedgers. This time, Garner wants us to look at the financial version of the report that breaks down large speculators into different categories. It's dealers, intermediaries, asset managers or institutions, or other reportables. What we care about is the asset manager category. That's the green line, right here. Lately, when it comes to the S&P futures, asset managers have racked up net long positions of nearly 1 million contracts. That's this green right here. Historically, when money managers have gotten this bullish in the past, the S&P tends to get hit with a sizable correction. Doesn't always derail the market, but, well, let's just say you're going to get hurt. The last few times asset managers got this bullish in the S&P futures, we got the financial crisis, the 2018 pullback, and the COVID crash, and the 2021 meltdown. Well, that's some great times. And that's got Garner wondering if last month's beatdown was enough, or if the S&P is still cruising for a bruising. You know what? She's betting on the latter. Now, I want to note that in 2018 and 2021, we sold off because of worries about rate hikes. But the Fed's about to give us a rate cut, for heaven's sake, next week. So maybe money managers are right to be bullish. Either way, though, the market would have more upside if we had more bears. That's how it works. Now, how about the grain side of the deflation trade? Check out the weekly chart of corn, which has both the typical commitments of traders data along with the more granular version that breaks down large speculators into different categories. That's one at the very bottom. The blue line shows managed money. Okay, now this is important. It's managed money. I mean, it's kind of, well, I'm going to ask you to just bear with me. This is the blue line. I don't know if you can tell. That it shows that near the lows, there were net shorts of 340,000 futures contracts. Now, this is the largest bearish position Garner's ever witnessed by large speculators or the managed money category in the expanded Commitment of Traders report. Zero precedent. But when people get this bearish about a commodity, these are all going down, notice? When they get this bearish about a commodity, it usually means the trend has exhausted itself. So where does she see the two sides of the deflation trade headed in the future? Now, here you go. Let's start with the monthly chart of the S&P futures, okay? I know, bear with me on this, too. Garner is a big believer in the idea that the S&P's gains were pulled forward for many years by government stimulus and the Fed's easy money policies. As we go back to more normal monetary and fiscal policy, assuming that's where we're headed, she thinks the S&P will have to normalize with its historical valuations, which would put it somewhere between 4,250 and 4,750, which, by the way, it's down maybe 1,000 points or more from right now. I'm not on board with that. The Fed squeezed the stimulus out of the system when it started tightening in 2022, and now it's about to start cutting rates. However, Garner points out that the RSI, the Relative Strength Index, which is down here, an important momentum indicator, has been making lower highs while the S&P 500 keeps making higher highs. As she sees it, that's a classic sign of the trend exhaustion. Of course, if we have a couple of good weeks, then Garner admits the S&P could go have another powerful leg higher. But if we get a monthly close below 5,500, well, look out below. I don't think we'll head back to our normalized price range, down roughly 1,000 points from here. But September tends to be horrific, so I wouldn't be surprised if the market has a bad month. That would certainly make sense. How about the monthly chart of corn prices? Look, if the deflation trade comes to an end, then Garner expects a short squeeze in corn. Okay, not just a rally, a short squeeze. The 20-year, remember she identified that one in cocoa not long ago. The 20-year trend in corn sits at roughly $3.40. The low a few weeks ago was $3.60. So she wouldn't be surprised if corn has already bottomed. It tested the key trend line, and the trend line held. Plus, the relative strength index is massively oversold. Boy, is that oversold. That's incredible. That means corn's due for a bounce. So here's the bottom line. The charts as interpreted by Carly Garner suggest that the long side of the trade has gotten overcrowded in the S&P 500, and the shorts have gotten overcrowded in corn. I don't think it's the end of the world, but it's tough for the market to rally consistently when we've got too many bulls. So don't get used to days like today. Let's take some calls. Why don't we go to Mike in South Dakota? Mike.
Hey there, Jim.
Mike, what's happening?
First of all, a big Go Birds booyah from Sioux Falls.
Absolutely. We need a little production from some of that defensive line, but I agree with you.
Yeah, okay. We got some cleaning up to do. Hey, first time, very long time. My question is simple. Is it worth hanging on to Halliburton? I got in at about 38. I was hoping to head to 48. It's closer to 28.
I'm going to say only on a valuation basis could bounce to 31, 32. But I think the oil business is going to be under pressure if Trump wins and going to be under pressure if Harris wins. So I don't know what to say. I don't have a positive scenario for the group. I'm quite sorry. So therefore, maybe get a little bit of bounce, but then you got to go. Let's go to Joe in New Jersey. Joe.
Hello, Mr. Cramer. Thank you for taking my call and for all teaching me the fundamentals of investing, like being diversified.
Oh, thank you. Yeah, we got to get everybody to stay in the game, and that's what diversification is about. Not about making a ton of money, but to keep you in for until we get better times. How can I help?
I'm considering buying Barrick Gold because of the rising prices for the precious metal. What should I do?
Well, I like Agnico Eagle more, frankly. They've got a dividend, and they've had a better record than gold, G-O-L-D, the Barrick kind, which is still Randgold. I just think it's not 6 or 8 or another. Agnico has got a demonstrably better growth portfolio and also a better capital allocation. All right, the charts as interpreted by Carly Garner suggest the long side of the trade has gotten overcrowded, the S&P 500. The shorts in corn, wow, is that thing about to fly. I don't think it's the end of the world, just a sign that the trade may be about to run its course. Now, much more Mad Money. I include my exclusive with Medtronic. After the stock hit a 52-week high last Wednesday, I'm seeing what's on the horizon with the CEO. Then I decided to put generative AI chatbots to the test. Do not miss the fascinating head-to-head results and how I'm scoring some of the newest tools in tech. It is a hoot. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. What do we do with the stock of Medtronic, the heavy hitter in the medical device space? Now that the stock has finally gotten some real lift, Medtronic's a fantastic way to play the healthcare utilization bull market. They make all sorts of devices for cardiovascular disease, neuroscience, surgery, and diabetes management. When these guys reported it was right near the end of August, they delivered an incredible quarter. And since then, we've seen a rotation in healthcare. Medtronic stock has rallied more than 6%. But earlier today, we got a chance to speak with Jeff Martha, the chairman and CEO of Medtronic, on their 75th anniversary. Take a look. Jeff, first, congratulations on 75 years. Not many companies have been able to do it, but your company has also pivoted. It's kind of a new Medtronic. What do you think?
Well, first of all, great to be here, Jim, and thanks for wearing the Medtronic blue. 75 years, it's really exciting, but what's more exciting is the next 75 years. To your point, in some ways we've pivoted, in some ways we're not. We're still that mission-driven company that we've always been, working with physicians, putting patients first. But, from a tech perspective, we've definitely evolved, and I'd say even lately pivoted a lot of robotics and data and AI, really defining our innovation. Really exciting.
Well, it's curious because when I saw you at JP Morgan beginning of the year, The number of approvals since I saw you, the way you have gone about exceeding everything that you told me in January shows me that you are leading a company that deserves a higher multiple and is certainly much more of a growth company than previous.
Right. 7 quarters in a row of mid-single-digit growth, and I think we've got more in the tank here because it's all coming from innovation that we've launched in the last couple of months, and we're creating new standards of care. Even it's not just a product; it's a new standard of care. Like for example, hypertension. Our Simplicity technology, what they call renal denervation, is a procedure to bring down your blood pressure, just approved by the FDA. So it's more than a technology; it's more than a product. It's going to become a new standard of care for people with hypertension around the world.
Well, let's talk about that because where are you in terms of reimbursement? Because I know that a lot of people feel, well, listen, the drugs work, but people don't take the drugs. So I'm sure that the FDA would say, wait a second, we got to see now whether the GLP-1s have something good against high blood pressure. Do you think there's a lot of resistance to what you want to do technologically?
No, I think we're not fighting anybody here. To your point, the patients are looking for something different. The pharma industry, these are generic drugs. This isn't something they're really focused on. Physicians are looking for a new solution. The FDA worked with us to get this breakthrough designation and have been a great partner. And now we're working with different insurance companies and CMS, and they see the potential here for patients. And I believe they want to do the right thing, and we're working with them on that reimbursement. The payments have been set for largely, and now we're working on the coverage. Like, okay, who gets covered? And we need broad coverage because only 1 in 4 people in this country have their hypertension under control. So this is a massive opportunity for us.
All right, now let's talk about something that I was kind of shocked at that you did. Team up with Abbott Labs. I mean, come on. I mean, something you're a sports fan, and then it's 2 teams colluding.
Well, I wouldn't call it collusion here. I am a very competitive person, and people were surprised that Medtronic and Abbott did this. But this is one of those rare cases, Jim, where it's a win-win-win. It's a win for Abbott, it's a win for Medtronic, and it's a win for patients because they get choice now. For our ecosystem of technology for insulin-dependent patients, largely type 1 patients, they'll have to choose between Abbott's continuous glucose sensor and Medtronic's that goes into our, like I said, this ecosystem of an insulin delivery device and AI-driven algorithms that help keep people's blood sugars under control. So Abbott gets access to our type 1 patients. We get access to their patients that are graduating or evolving into our therapy.
Well, good for both. Now, let me ask you about GLP-1s. You're the first person ever admitted they had any impact, although it's on bariatric, which I totally understand. At the same time, there is a diabetes competition from it. Can you tell me where you stand right now on how bad or good the GLP-1s are for your company?
It really hasn't had a big impact on the company now, and I don't see it in the future. Where it's impacting us right now is bariatric surgery. We do bariatric surgery for obese patients, and these GLP-1s are helping them. But the docs are telling me that the GLP-1s are really just getting patients less obese, and we'll get them into our patient pathway for surgery. Not all, but some. So we'll see how but the rest of the company hasn't impacted. Like, for example, our diabetes products.
It hasn't.
It hasn't because we're type 1, and that's where your pancreas just isn't working right, and GLP-1s don't help that.
Okay, so now let me go back to AI. I need your help. I'm a big believer in AI and what it means for tech. People have turned on AI. They say that the consumer doesn't care about it. It hasn't shown the results that a lot of people think. Where are you in AI?
We're really bullish on it. I mean, we're not for our products for patients. We're not talking about generative AI. We're talking about like deep learning models, regulated by the FDA, like GI Genius, for example, for colonoscopies. That's our AI-driven technology for colonoscopies. Just to give you one example. We use 13 million colonoscopy videos to train the AI algorithm.
So in other words, give it to the chip, so to speak.
Right.
Go ahead.
To train the algorithm to find these polyps. And what we found is that physicians are missing up to 50% of the polyps.
How much?
Up to 50%. 50. In the real world. And as the day goes on, their eyes get tired. It's a lot of colonoscopies. And the AI doesn't get tired. So this, as you know, these polyps have a high correlation, a causation for cancer. It's easily preventable. So that's just one example of how powerful it is. And we wove that AI algorithm right into the existing physician workflow. So they don't have to do anything incremental, anything more. It's quickly becoming the standard of care.
Well, it's almost malpractice if you don't use it.
As I say, it's quickly becoming a standard of care in this country and around the world. Not just here, but I was just in India a couple months ago. They've adopted it because they don't have the same level of trained physicians. This democratizes, good health care.
Do you think it's possible that altogether it could be more than $1 billion?
Not that just that one area. It's
but all AI.
Oh, easily.
Really?
I think about surgery.
This is why it's so upsetting to me that people don't believe in it. Look, you are a med tech company, and you're telling me it's meaningful.
Very much. Just think of just surgery alone today. Your surgery is dictated by what's in the surgeon's mind and what he or she can do with their hands, the dexterity.
Right.
Between robotics and AI, we're complementing both. And again, democratizing good surgery around this country and around the world with the combination of AI and robotics.
Now, I don't want to overlook, cardiac ablation, core Medtronic, just keeps advancing technologically versus others.
Right. Ablation for atrial fibrillation is a big one. Right? A lot of people suffer AFib as the population gets older. And, us and others in the industry are pioneering a new technology called pulse field ablation that is very safe for AFib patients, and it's taking over and quickly becoming a new standard of care.
Yeah, I know. The baby boomers are faced with it more than I ever thought.
It's almost like, if you live a certain lifestyle and live it long enough, you're going to get AFib.
Oh, well, let's hope it doesn't happen to too many people. This is Jeff Martha, Medtronic Chairman and CEO. And again, congratulations on 75 years.
Thank you, Jim.
Mad Money's back in for the break.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next.
It is time to start with the light round quiz. We're saying this talk said about myself. So let's talk with it on my staff. Prepare for the beverage on fire. You plan to sell. And then the lightning round is over. Are you ready, Ski Daddy? Time for the light round quiz. Let's start with Roger in California. Roger.
Hey, Jim. What do you think of the stock AES, regardless of the outcome of the election?
Okay, I think it's good at 4% yield. I'm surprised it is this low. It's very inexpensive. Let's go for it. I want to go to Jim in Florida. Jim.
Jimmy Chill, a big Naples, Pelican Marsh, booyah to you.
Oh, lucky you. Let's go to work. What's up?
Well, I want to thank you and your staff for all the years of help to start.
Oh, thank you.
My question's on a wind and solar company, which I've added to my position several times. It has an unusually high dividend, over 14%, and the earnings per share on different sites are different on every one. CNBC has $1.64, Yahoo has $1.54, Raymond James has $3.18. Buy, sell, or hold NEP.
Well, you know what? Just on that disparity, I think I've got to do more work. I'm looking right now at our chief scientist and also research director, Ben Stoto. I don't get this. I got to find out what's the truth, and then we will come back with a more considered opinion. Why don't we go to GIF in California? GIF.
Hey, Jim. Booyah from San Diego.
Oh, man, you're a lucky person. What's up?
I'm interested in Vertiv Holdings.
Vertiv's come down enough. I've had it with the sellers. They ought to recognize that the time to sell has come and gone, okay? Come and gone. Let's go to Jerry in Missouri. Jerry.
Hey, Jim. Thanks for taking my call.
Of course.
Hertz has a new CEO and 2 new board members, but no other news or catalysts. Should I keep holding?
The time to go and Hertz has not. It's still ahead of us. How about that? That stock really does have me very concerned. Big lots concerned. Oh, I mean, big concern. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, have a chat. Cramer test drives the big AI offerings, and his experience may surprise you. Next.
When I saw the announcement Friday night that Palantir, Dell, and the relatively unknown insurance company Erie Indemnity would be joining the S&P 500 late last Friday, all I wanted to know was who got kicked out to make room. So I went into Alphabet's free Gemini, Anthropic's Claude, Microsoft's Copilot, ChatGPT, both free and paid, and then Meta AI. Find out. Why not? Let's give this a runaround, huh? Well, it was a runaround. OMG. Talk about a hallucination. This is the Timothy Leary turn on, tune in, drop out version of research. I can't believe how varied and how wrong the answers were. Before I get into this, let me give you the caveat that these free generative AI platforms are not reliable research tools, at least not yet. For the record, S&P booted American Airlines, Etsy, and Biorad Laboratories last week in a readily accessible format. It should have been available to any services that aggregate news. I happened to back into this exercise after reluctantly going to Google News Search, which I knew would send me to some sites that didn't belong in any thinking queue, often old or odd ones. Sure enough, the top reference, The View from the Wing, which only talked about American Airlines exiting and neglecting the other two. Google brought up a second article from Fortune talking about 3 being kicked out, but they were Robert Half, Comerica, and Illumina, which were booted back on June 24th. So much for Google search. But how about Google's Gemini? It had a strange answer, more of a stupor than hallucination. Flagging the S&P added Olin and T-Mobile, but made no deletions. Hard to be so wrong. I mean, so we told Gemini that it gave the wrong answer. It came back immediately and said, you were absolutely right. I apologize for the oversight. Here are the correct S&P 500 constituent changes announced on Friday, September 6, 2024. Companies added Olin, T-Mobile, and West Pharmaceutical. Companies removed Medicines, Fortinet, and the Corbett King Company. These changes were effective Monday, September 9, 2024. I will be more diligent in verifying my information in the future. Thank you for catching my mistake. Again, completely and utterly wrong. Gemini promised to be more diligent in verifying its information in the future, so we fed it the readily accessible facts of the situation. It then repeated what we said, apologized again for thanking me for my patience. Gemini wasn't alone in botching it. Claude, the Gen AI system from Anthropic, said the companies most recently removed from the S&P 500 were Spirit Aerosystems, Dish Network, and First Solar as part of a periodic review. Now, we corrected Claude. We weren't hard, but we corrected Claude straight away and acknowledged the information was incorrect. It was abject, telling us we're absolutely right, and it appreciated taking the time to ensure Claude has the right information. Claude said, and I quote, "It will make me a better assistant going forward," end quote. So glad we could help train Claude. Then we checked out Perplexity. A lot of the young people tell me this is where to go, and I'm hearing great things. But it defaulted to Robert Half, Comerica, and Illumina, the ones that got booted in June. Then it quoted me, of all people, in a piece from that month saying you shouldn't buy these stocks because they will most likely underperform. While I was indeed flattered, I would have felt better if Perplexity had just given me the right answer. Meta AI gave us the wrong answers too, but at least they were from June. We made that clear and then you know what it did? It apologized profusely and then gave us the right answer. It promised to double check going forward and simply admit if it doesn't know the answer rather than giving us incorrect information. I learned that in 3rd grade. Microsoft's Copilot, which is more of an aggregator, got it wrong with Robert Half, Comerica, and Illumina. We corrected it and then we thanked it for pointing out the right answer. It pledged to be it was happy that we pointed out the right answer. It said to be more accurate in the future. It was very polite. It was really mattered. It was a tremendous show of humility. Then we went to ChatGPT, which is owned in part by Microsoft, but is the brainchild of OpenAI. Its free version said the S&P 500 had no updates since September of 2021. But here's the capitalist clinker. We then went to ChatGPT 4. The paid version, $20 a month, and guess what? It had the correct answers, American Airlines, Etsy, and Biorad. Maybe the true lesson of my foray into generative AI is very simple. You get what you pay for. I like to say there's always bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and/or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.